Helping out family is one of the most important things in life. But what do you do when they need a safe place to live and just can't get a mortgage on their own? It's a really tough spot to be in. But what if I told you there's a financial tool out there designed for this exact situation? Maybe you're thinking about your parents and you want to get them into a nice, accessible, one-story home. Or perhaps it's your adult child with a disability and you just want to make sure they have stability and a place to call their own. That financial wall can seem impossible to climb. You want to help, but how? Well, it turns out there's an answer. The solution is a special type of loan. Now, you might hear people call it the Family Opportunity Mortgage, but that name is a bit outdated. The important thing is it's specifically built to help you buy a home for a loved one, and it gets rid of the biggest hurdles you'd normally face.
So what is it exactly? At its core, it's a conventional loan, which just means it's a standard mortgage backed by big players like Fannie Mae or Freddie Mac. But here's the unique part, the part that makes all the difference. It lets you buy a primary home for your parent or child, even if you're not going to live there yourself. That's the key.
Okay, here is a really critical piece of advice. Don't walk into a lender's office and ask for a family opportunity mortgage by name. They might not know what you're talking about because that term isn't really used officially anymore. Instead, just tell them your story. Say something like, look, I want to buy a house for my elderly mom to live in as her primary residence. She can't qualify on her own. What can you do for me? They'll know exactly which loan program to point you to. And this is the absolute game changer. Even though you won't be living in the house, the lender treats the loan as if it's for your own primary home. It's not treated like a second home or an investment property. And let me tell you, that single distinction makes a massive, massive difference to your wallet. So what does that actually mean for you? Well, for starters, let's talk about the down payment. If you were buying this as a typical investment property, you'd probably need to put down 20, maybe even 25%. But with this loan, that number can drop to as low as 5%. Just think about that. On a $300,000 house, that's the difference between needing $15,000 and needing $60,000. That's huge. And the savings don't stop there. The other massive benefit is your interest rate. Because the loan is treated like you're gonna live there, you get a much lower rate than you would on an investment property. Now, that might just seem like a small percentage point here or there, but trust me, over the life of a 30-year mortgage, that adds up to tens of thousands of dollars in saved interest payments. And there's more good news. You're also looking at more flexible loan terms, and you might even get to deduct the property taxes. It's a whole package of benefits designed to make this possible. So it all sounds pretty great, right? The next logical question is, who can actually get one of these? All right, with all those fantastic benefits on the table, let's get down to the nitty-gritty. Who qualifies? There are some clear rules both for you as the person borrowing the money and for the house itself. Let's break it down. For you, the borrower, lenders are going to want to see a pretty solid credit score, usually 620 or higher, and of course, proof of a stable income. They'll also look at your debt-to-income ratio, or DTI, which is really just a simple way of comparing your monthly bills to your monthly income. As for the house itself, the rules are straightforward. It has to be your loved one's main home, it needs to be in decent shape with working utilities, and it can't be a commercial building or a farm. Pretty simple, right? Okay, so let's say you tick all the boxes. You qualify, the property qualifies. So what's the actual process look like from here? It can feel a little intimidating, but honestly, it's a pretty clear 5-step journey to getting those keys into your loved one's hands. Here's the basic roadmap. Step 1, you and your family member go find the perfect house. Step 2, and this is a big one, talk to a few different lenders. Get pre-approved by more than one so you can compare their offers. After that, you'll formally apply, go through the standard underwriting where they check all your paperwork, and then finally, you close the deal. It really follows the same path as any other home loan. So, we've gone over what this loan is, why it's so beneficial, and the steps to actually get one. Now let's just pull it all together and talk about what you should be thinking about as you consider your family's future. So, what's the bottom line here? It's simple, really. This is an incredibly powerful and specific tool. It's designed to let you take care of your family by giving you access to the better interest rates and the lower down payment you'd get on your own home without you actually having to move in. Now, before you run off to call a lender, here is the single most important thing you need to do next. Please, talk to a qualified financial advisor. They can look at your entire financial picture and help you figure out if this is truly the best move for you. Plus, they might know about other state or local programs that could help too.
At the end of the day, this is an amazing option that can provide real security and peace of mind for the people you love the most. So the only question left to ask is, could this be the key that unlocks your family's next front door?